Hey there, it's Dave with Flipperforce. Got open our Flip Analyzer tool here. Just going to show you our new advanced loan options that we just added to our financing setup page. So you can see we've got a loan set up here for a purchase and rehab loan. So essentially we are going to be getting a loan from a lender for 75% of the purchase amount and 100% of the rehab costs, for a total loan amount of $182,000. We've set up our loan terms here, so we've got an annual interest rate at 12%. We're going to be making 5 monthly payments, and then we're going to be paying 2 percentage points up front to the lender. And then finally, our new advanced loan options is our new functionality that we just added that really allows you to fine-tune when your points payments are going to be made, when those interest payments are going to be made, and then how you're going to receive the rehab funds from your lender. So what you'll see here is our points payment schedule. So this is basically going to be give you the ability to set up when you are going to be paying your points. So most lenders require you to pay your points up front, but some lenders will allow you to wait until you actually sell the property to pay those points out of the proceeds of the sale. So if your lender is going to allow you to do that, you can select end of loan, but again, the default setting is to have you pay those points up front. Same thing with the interest payments that you're going to be making to your lender. The default setting, and most lenders are going to be requiring you to pay those monthly interest payments on a monthly basis, but some lenders will allow you to hold back those interest payments and pay those out of the proceeds of the sale when you actually sell the property. So if that's going to be the case, then you can actually change that setting to pay those interest payments at the end of the loan. And then finally, you've got your rehab fund. So this is when you're actually going to be receiving your funds for the rehab portion. So you can see again, we were getting a loan from our lender for the rehab portion here of 100% of the rehab, so $70,000. So basically what this is going to be doing is it's setting up the settings for when you're going to receive those funds. So most lenders are going to hold back those funds. They're not going to give you all of the funds up front when you buy the property. They're going to hold it back and pay you and disperse those funds as work is completed on the project. Otherwise, if your lender is actually going to be giving you all of those funds up front, so that's $70,000 up front, you can select the upfront option, and then that will designate those funds as being received up front. So let's show you what this affects. It actually affects the project capital and funding costs over time that you'll receive in your project capital over time diagram. So this is a new table that we've added to the results page here for your flip analysis. And what you'll notice is first and foremost, you've got your interest payments. So the interest payments, those are going to be paid monthly. So again, if we go back to our setting that we had previously, the interest payments were set up to be paid on a monthly basis. If we would have had that set up to be paid at the end of the loan, it would actually land here in the sale closing column, because those interest payments, they're going to be paid for out of the proceeds of the sale. So since we do have that as monthly, it's just going to be basically paying those interest payments on a monthly basis during the entire holding period. Same thing with the points. So the setting was, do you want to pay the points up front, or do you want to pay them on the back end at the end of the loan when you actually go to sell the property? So we had our points being paid up front, so that's why they're being paid at purchase closing. If we change that setting to be paid at the end of the loan, those points would actually be paid for out of the proceeds of the sale in the sale closing column. The final thing that we need to take a look at is the rehab funds. So you can see again, we're getting 75% of the purchase at closing, so we're getting $112,000 up front at closing for the purchase amount, but then we're going to be receiving 100% of the rehab funds on a draw basis. So again, those were being held back was the setting that we had set up. So basically the lender's not going to give us all of that up front at purchase closing. They're going to hold back those funds, and they're going to give us those funds as the work is completed. So based upon the way that we've got this broken out, we've got a $70,000 renovation budget. Basically, we've got $23,000 per month is how that's divvied up over that 3-month renovation period. And so the lender's basically going to be giving us $23,000 per month. They're going to hold it back and give us those disbursements as draws as the work is completed. Now, if we change that setting to get all of the proceeds up front, they would have given us that entire $70,000 up front here. So we can go switch this stuff around real quick just to kind of show you how this ends up laying out, but that's where all of that data and information feeds from when you change your settings here. So if we change this to end of loan, if we change this to up front for the rehab funds, we go back over here to the results page, you'll see how that ends up being allocated over here on the project timeline. So you can see if we go down here to the rehab funds here, we're actually receiving those rehab funds at purchase closing. Previously it was being distributed as a monthly draw here from month 1, 2, and 3 during the renovation, but now they're giving us all $70,000 up front, and you can see how that affects our cash outlay here. We actually are going to have a positive amount of cash in this deal because we only needed $153,000 for the purchase closing, which was basically just our purchase amount and our buying costs, but the lender is giving us $182,000, so we're actually going to have $29,000 up front that we don't necessarily need. And then as we start to spend money over the course of the renovation, you can see how that starts to draw down. So this little orange line here is basically our cumulative cash position. So you can see we are at a positive cash position at closing because they gave us too much money. As we start to spend money on the renovations, our cash position is going to start going down, and it'll eventually be negative as we start to spend more money on the project. So this diagram here is just going to show you what your monthly cash flow or cash outlays are going to be, and then this orange line is going to show you what your net cumulative cash position is each month of the project. And then eventually when you go to sell the property, you get that big payday at the end. You're paying back yourself for all the project cash that you invested into the property. You got to pay off the loan fund, so we've got $182,000 that we got to pay the lender back. We also got to pay for the sales commissions to our agents. So then our net profit after paying back everybody and paying back ourselves for the cash we had invested, we've got a $36,000 profit. So those advanced loan options again are going to be used to really just help you build out your interest payments, your points, and your rehab funds across this new timeline that we got. So that way you can really forecast your capital, your project costs, and your funding, and your cash outlays more accurately over time. So hope you like that new feature. If you have any other questions or anything, let us know.